This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GoldenPhi.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning Andrew Joseph, who is no stranger to our Trigger Webzine subscribers and our now 4 times a week technical and market alert updates. Andrew is principal of GoldenPhi, publisher of Trigger's Media Publications, Inc., and editor of the Trigger's Webzine and website. Good morning, Andrew. Welcome back to Macro Analytics.
Good morning, Gordon. Thanks for having me back.
How quickly the month goes by, isn't it?
Oh, yes. It's almost winter.
I hope you had a good summer.
Yeah, that went too quick as always.
Of course, summer's short in Canada, is it not?
I guess we have seasons, yes.
Okay. I just had to mention that. Anyway, Andrew, we're always short of time, so I'm going to move right into the charts here. But before we do, I need to mention that these slides are for discussion and educational purposes only. Do not trade from any of these charts. Andrew and I are not giving investment advice, nor should it be construed as such. Always consult a professional investment advisor before making any investment decisions. Having said that, Andrew, before we show our charts, could you just give our listeners, maybe our first-time listeners, an orientation to the charts so that they can easily understand them and your high-probability trading zones and how to interpret those?
Sure, yeah. If you take a look at what we have up right now, the charts may look a little busy. What you want to focus on are the arrows. And the arrows are sitting on technical triggers, and these are whatever the moving averages, support resistance lines, whatever the technical is at the time, holding the market. When the market crosses these, it's going to move to the next one. And as it moves through these, you can see the green boxes, and this is where we expect the market to get to. And this is usually a confluence of a bunch of tools coming together, telling the same story, saying this is most likely where the market's going to move to. And so we look at the chart and we see where the targets are, and we watch the market as it moves across our triggers, and the arrows point to us where it is and where it's going to move to. And so as we go through the charts, what we want to look at is the targets in the green boxes and where the arrows are looking at and pointing at the triggers.
And those green boxes are your high probability trading zones?
Yes, those are where we expect the market to move to. We've had some pretty good success when the market does decide to make its move and it shows us and it crosses a significant trigger. We're having anywhere between 80 and 90% accuracy in reaching those target areas. And part of what we're doing here is, although the target is great, that this methodology can be used even if we disregard the target. And I say that because we're moving from one technical level to the next technical level, and it does this very consistently. And then it's an 80-90% chance if it actually hits that target exactly.
So how does a day trader, position trader, trend follower trader, a swing trader use this methodology?
They're watching the market, and we'll know where it's a point that we expect a move to come based on, say, some of your macro stuff that we expect a certain day to have a movement. And then we go to the technicals on the chart, and the movement, it's where the chart is. Will be bounded usually by technical triggers, whether there'll be support lines or moving averages. There'll be something bounding the current market.
So this is a tool that might be used to supplement a trading strategy that somebody would have, but not to trade from it, but to use it just as another tool in their toolbox.
Yeah, this is a methodology. It's not a trading plan, and the methodology, it can be the backbone for someone's own trading plan, and depending on their style, because whether you're an investor or you're a day trader, the same rules apply, and they work on the long-term charts or very short-term charts. And the point is that when you have this methodology, it gives you a roadmap of where we see the market will most likely move to, the next levels it's going to move to, and the next targets it's going to move to, and then how the trader invests or trades with that is up to them and their risk tolerances and how they want to pursue that. But we give a very clear roadmap of what's happening and where the market's going to move to level next, and usually right on time as well as to where it's going to go.
Now, you use the term technical triggers and high probability trading zones. I have up the front page of one of your number of daily plans that you have, this one tracking the S&P. Could you just give us an introduction to what you mean by macro drivers and macro triggers to differentiate that?
Yeah, the technical triggers are what you see on the charts that we were just looking at, and those are the supports and resistances and the technicals that are carrying the market. This is the supports and resistances of the technical triggers that we're looking at, as opposed to the macro triggers and drivers, which we get from yourself, and those are telling the focusing on a key date or an event that will happen, and then on that day we then go to the technical triggers. But it's your actual macro and drivers that set up whether we're going to have a move that day, and maybe you want to talk to those.
At GoldenPhi.com, if you were looking at charts, think of us as coming from the monthly and weekly charts and working down, as opposed to the 60-minute daily and working up. So we're looking at the big picture, trying to identify really on a quarterly basis where the swings are from a trend standpoint, and what will be driving them globally. And that's why we talk to some of the best minds around the world in our macro analytics video series, which is on YouTube. And then we take that and we map it into our global macro tipping points services, which is a very, very comprehensive set at the look at the macro position, not technical, but the analytics and the indicators with it. And then we overlay it into our market analytics and technical analysis service where we actually get into the charts. So the bottom line of it is we come up with some conclusions on what the drivers and the macro triggers are going to be. And it allows us to establish some time zones, some trigger zones, so that the trigger zones would say that we think based on the current debt crisis and ceilings that, and tying that into, say, Bradley turn dates and phi clusters, that we think that this point, this is when the market will start to reach a certain zone, and then we'll make a move. And we also identify what the drivers are on it. It could be the euro yen cross. It could be the yen itself, because a lot of times it's currencies. It could be credits, and we lay those in of what might be the drivers, and then come up with an opinion on what we think the bias is going to be. That is, at that point, the market is likely to have a risk-off trade or have a risk-on trade. We don't have any idea how far it's going to move, but when you overlay that onto your technical charts, Andrew, we get a pretty good idea of the translations and tying it together. And I have up your 60-minute chart that kind of ties them together here.
Yeah, they're working very well together. You give us the zones based on the macro analytics that you're doing, and then we look at the charts. And your zones can give us a bias too. I know sometimes we think that's a good chance the market's going to move up or it's going to move down. But regardless of which one it does, when you overlay those zones on the technicals, when the market does make a move up or down, it's going to move through the technicals, and this will allow you to do to make your own decisions as when you're going to start to get in or out as it moves through these technicals. You know the day and the time based on your macros, and then by following the technicals on the chart, you can follow the market on the correct direction by following along with it, as opposed to just guessing what it's going to do. And if we look at today's the chart we have up right now, and incidentally, this was I think from a week or so ago, and we were sitting at a different level than where we are now. The market actually moves right into our target, as we're seeing. It goes through the triggers, the technical triggers that we have marked there by the arrows, and then consolidates at that first high probability target, and then lifts up and goes into our next. And now we're sitting and waiting as we move over to the next time zone, which is D that we're showing here. And most likely we'll see the next reaction from the market, which you're anticipating will most likely be a down. Is it not, Gordon?
Yeah, I'm seeing, and we'll show some charts, that as we get into a combination of the FOMC meeting on the 30th, mutual funds year-end, October 31st, beginning of the year, as they paint their returns, and we have a very critical Bradley turn date, November 3rd. It's signaling that the market likely, and Europe, there's some keys in Europe, is suggesting that that's where this market's going to hover to from a time zone, and then it looks like this is a top, and we will start to head down for a period of time on a risk off. That's what the macro is suggesting. And what's important, Andrew, is these are macro views. Generally, they're pretty accurate, because the world is moving in such a coordinated fashion. But they're only tools to add to your existing analysis and to keep an eye on it. Let's talk through some charts here. What we're seeing to make better sense of this, Andrew. I have up your weekly S&P chart right now.
Yeah, and this is fairly current, and we can see that the market is up, again, testing our red support and resistance from the wedge pattern, which you can see in the larger picture. We have if we keep going higher, I know you've been talking about Dow 20,000, and we've had a lot of people saying it's going higher. And technically here we can see 19,000 for sure is definitely or 1900 is definitely a possibility. There's no, once we go up through these technicals, there's nothing stopping us. The next Fibonacci and where the channel all comes together looks pretty consistent, so we'll have to see if that's what happens. Otherwise, there's, from right now, a possibility to drop down before that happens. And, we can see that in, the inlay. We have several technicals that if we start to drop will tell us that we are dropping and that we can use them as triggers to go down to their next targets.
As a point of clarification, Andrew, I've put out quite a number of videos with leading experts on called Dow 20,000. I don't see it going there. I do see the beginnings of a crack-up boom. I do see a correction consolidation. We'll show some charts on that. And then a final lift, probably into end of first quarter. But I see it slightly less, somewhere around 1810 to 1820 on the S&P. There is a chance it could blow off a little further with coordinated global action. Right now, it's suggesting that. These charts you've got to watch very closely, and you're putting these out on a daily basis, and everything is fairly rapidly changing geopolitically. But that's what they're currently showing. Now, I'm showing a chart here, Andrew, from the charting sections that we include with the drivers and the triggers on your daily updates. And these are boundary conditions that were established in the 2008 financial crisis. And I don't go back into that particular era, but these boundaries, these deviations from some predetermined standard moving averages was suggesting to us that this is where the market was going. And you can see in the red circle, that's exactly where we went to. And typically, consistently, we've had some sort of pullback from there. Now, where it's going to go and whether we have a cross or not is yet to be determined. It's our opinion that it'll move to the 200-day moving average in a corrective consolidation pattern right now as we look at the charts. And what we're seeing and why we believe that, this is the channel going into 5 years now. And it's been a very, very clear channel. We're at the higher end of it. But what's important is on the top, the RSI. We have a major divergence from relative strength. So this is typically a classic example of where you'll get a pullback. It doesn't say a major market turn, just a pullback and a consolidation. And the consolidation we're looking for is something that's a classic triangle pattern continuation, which is an A, B, C, D, E, and we're showing it here with what we think it's likely to be. And one of the reasons we feel that is because the markets typically, from an Elliott wave standpoint, do something called alternation. And I don't think we've ever seen it not work in that fashion. So if you were to look at this long channel, and I label it in this fashion, the AB was a major pullback. But when you have a major pullback, the second retracement is usually more flat. And in a 5-wave up, whether you call it 5 waves or A, B, C, D, E. So that's why we see this alternation in a triangle pattern moving to the right. And you can see in this longer channel, we're right at the top of that particular channel now. And where we track these into the triggers, and when I call triggers, I'm talking the macro triggers. I'm showing here on the left indexed, and the key dates. And it's signaling key kinds of macro events on this particular chart, which to us suggests that the pattern is probably this pullback where I suggested maybe the 200-day average, labeled here, through the dates that we had where we think we have after this Bradley turn date, we have historic 6 Hindenburg Omen expirations through November 15th, 5 clusters. This suggests downtime as they worry about this U.S. budget conference debt ceiling on December the 13th. So we think that's going to be a risk-off period. How deep that is, that's something you need to watch your charts on. though we've currently labeled it the 200-day moving average. The thing we've really got our eye on, Andrew, from a macro standpoint, is Europe. We think this is a European stock 600 chart, and it's right up at the top, and the relative strength. And we think that the pullback and the risk off likely will come out of the EU. The euro-yen has been extending and is showing in your charts dramatically because of the yen. And specifically what's happening now is there's a real strong sense that the yen is about to collapse even further with its Abenomics. And that's driving the carry trade. And that's where we'll think we'll see a consolidation. A little long-winded, Andrew, but just to show you how we try and overlay the macro perspective on your technical charts. This is your VIX chart. From our opinion, you're about to see, we believe, the VIX explode higher. Not necessarily new highs, but certainly higher. And I think your technical charts are suggesting that.
Yeah, well, it's at an inflection point right now. It's come down on these the lows of recent all times, as you can see on the chart there. And it's going to it's coming to a point, and it's going to make a decision very soon, and it doesn't really have anywhere to go but up. If the market does push higher, then we can see, the S&P push higher, we can see the VIX possibly coming down lower still initially. As you can see on the very left-hand side of the chart there, how low we got. That's another all-time low. Possibly go down there, but eventually it's going to break, and then we're going to see some extended volatility. That's just what the chart technically says is going to happen when this wedge breaks.
What's very important for listeners to realize is the VIX is a measure of volatility, but it's based on options pricing, and it's the degree of what people are willing to pay on the derivatives options, whether puts or calls. So much hedging is going on where we're using derivatives to do hedging that the VIX itself becomes a very funny measure today. It's really a measure of derivative pricing and hedging. And so that's where what you'll see is this big shift in hedging. And that's really centered on a risk-off, risk-on conversion that needs to happen. And we believe that it's going to come out of the currency and credit markets. We've seen moves in the dollar that's been part of driving this lift. When you get a weak dollar, more times than not, the equities go up because you takes more of those dollars to buy it, the equity. And that's what we've seen here. And the U.S. short term, very short term, is showing a little bit more weakness in the U.S. dollar, is it not?
Yeah, well, it's at another point here where it's pretty critical, where we're sitting on a very significant trend line. It could come have a throwover for that from a little bit, but the next major support, as you can see, is all the way down at the red support. Now, whether we'll get down that low or not, I'm not sure. But that pattern at the very top and the inlay you see before we started down almost looks like a reversal diamond. So we'll see how low this gets as the market comes down.
We think, Andrew, that I'm showing labeling here where we think it's going to go into this 5 range. It's a little bit lower, whether it'll push that particular channel, but there's weakness in it for the macro drivers messages that we've reflected. And really, it's not so much the U.S. dollar as the euro, yen, and the cross trades in it. Now, if you look at a longer term, what we believe what's happening with the dollar, it's really in a major long-term downtrend that's shown in the red. And we're in the middle of a consolidation correction that's upwards to an upward downturning trend line. But we're in the middle of a correction period within it, and that's the gray area. And whether we get down a little bit to the midpoint of that long-term channel, we're not quite sure, but it's certainly a little bit more weakness. Then we see strength in the U.S. And that strength in the U.S. dollar is not because there's good things happening in the U.S. It's because of a global slowdown and a fear trade. And there's going to be a flight to safety, the perceived safety being the U.S. dollar. Let me call it the least ugly at the beauty pageant. And so it'll push money into the U.S. dollar. Typically that means a collapsing equity market. But in this case, it's not going to follow that pattern. The equity markets will lift for the same reason. It'll be a fear into protection of assets, and the U.S. major S&P stocks will be perceived short-term as we lift into that trigger zone of E that I'd labeled before in the spring time frame. That's what the macros are suggesting to us right now. Comments on that, Andrew?
Yes, it's reflecting in the euro-yen currencies, what you're saying exactly.
I have up your charts on the various crosses. This is euro-yen, and if I believe we're going to see a plummeting yen, that's coming. And there could be some weakness in the euro itself, but it's relative to how fast the yen goes down. What's your euro-yen cross trade suggesting?
Well, by your explanation there, we should have a lift out of the technicals that we have here. However, the technicals are saying just the opposite, because we have a divergence on the Williams, and then we also have an ascending triangle, which is also a reversal pattern. So we'll see that just because the technicals say that, I mean, they're always tricky, right? Surprises come and happen, and sometimes the market's printed that way specifically just to fool everybody. So we'll see. But the triggers there are very clear, as we can see the top blue line on the inlay. Once that breaks, we're breaking out of a wedge pattern, or if it drops below, there's some fib clusters right below. If we start dropping through there on the base of it, then we have a down, most likely. And one or the other will be the next major move.
The key here is how both of them will devalue relative to each other. We think the yen is going to fall off, as you can see here in this particular chart of just the yen trade index. And clearly it's almost a classic pattern, is it not?
Yes.
So it's suggesting maybe a little bit more time, but we should see fairly significant weakness in the yen. But we believe we're going to see some weakness in the euro. So it's relative to each other at over what period, the speed change. And here's the euro relative to the US dollar.
And again, you can see we're at some significant technicals. There's a very a long-term wedge pattern that would come up, resistance that we're almost at, and we should potentially see a reversal. If we don't see a reversal, then we're breaking a wedge, and we're going to be moving higher. But this is a significant technical that we're coming up to, and so it should be watched to see what happens.
I think the conclusion that we're reaching multiple major pivots.
Exactly.
In all forms of markets. And that suggests that becomes a time that you need to get on the edge of your chair and watch pretty closely.
Exactly.
And pay attention to then move from the macro to move to the technicals, because we found with a high probability trading zone, when they start to move from the trigger, whether the technical trigger or the macro trigger, they usually go to that high probability trading zone. So when they move, you've got a pretty good idea of where it's going to move to. These are all nominal charts we're talking about. They're all U.S. dollar base. But if you were to price these in real terms and denominate it in whether black gold or real gold, you need to be looking at what's happening in, I'll refer to as the hard currencies. What's your gold and oil charts telling you?
Well, gold is interesting. We've had a huge drop, as you can see in the chart, and we've started to put in some time. And there's been lots of speculation that the bottom's in and we're going to lift, and anything's possible. But technically, when you have a huge drop, you got to put in some time. Price and time need to equal out. So what that says is we need some more time to the right. And if we look at the red circles that I have in there, those are Fibonacci circles, we can see the market has followed them very consistently down up until the very last bottom, which it didn't quite make it. So if the market at some points comes down further in time on the right-hand side, we can see that those circles curve. We don't need to make any new lows to hit that to hit that red circle and fulfill both the Fibonacci circle and the time requirement for price and time that we talked about initially from the huge drop that we had. So technically, this is telling you that we're going to move over to the right and hit our second low. Now, how we get there, the exact path, the current consolidation that we are in could be an A-B with starting a C, which means we're going to make a new high, probably up into past that second or middle red line channel that you see there before it drops back down again. That's what's looking at technically.
From a macro standpoint, we think there's one more down move in gold, one more fear move, and more time, and then a significant lift. And where that ties into is the central banks are going to have to print significantly more money and credit into the system. And they're overextended now in terms of they need to be increasing the level. They're going to need a fear trade to step in, probably at that December FOMC meeting, to start signaling not only has taper been pushed out, but they may want to take coordinated actions with the other central banks, because the economies of the world are slowing dramatically and a potential U.S. recession is actually starting to loom. And we got all sorts of charts that suggest that. So there'll be the gold will then, once that they start to signal that they're going to increase the liquidity rates again, gold will then move up from that point, which is starting to give you a sense of timing in real terms. And what does your oil chart suggest?
Oil has been interesting as well. If we take a look longer back from the left-hand side of the chart, we can see that it has been consolidating or constricting as it getting smaller and smaller within itself until lately we've had a breakout. And this is the first time in like 4 years that we've had the market move higher and expand as opposed to contract that it's been doing. Currently, it's coming back down on itself. And if you look at the bottom left-hand corner of the chart, you can see a black trend line start. And if you take that all the way up through our chart, you can see we're almost at that now. And that's a pretty significant trend line, again, that we're coming up to. So when it hits this, the market has a good chance of bouncing. But if it doesn't and it breaks through, then there's a good chance it's going to fall even further and could go down to the lows that we see inside the black channel a little bit to the left.
You know, when economies of the world start to slow, they don't need as much oil. And so you start to typically get weakness. But on the other hand, what we have right now is the biggest exporter of oil in the world now has become China and Asia. And the biggest or importer and the biggest exporter is clearly Saudi Arabia and Russia. And they have now reached the point where they no longer want to trade those in U.S. dollars because the petrodollar is based on the fact that you can only buy and sell oil in the world in U.S. dollars, and they happen to have a problem with that as the United States debases its dollars. So now they're setting up to use their own currencies. When you do that, then you have a massive amount, 6 trillion U.S. dollars, that are not needed as much on your books so that your country's able to buy oil and import it. You maybe need more yuan and renminbi or other currencies to do, or even your own currencies to do trading. So that has a potential issue with the U.S. dollar. Imminently, no. By the spring of 2014, likely. But it's also starting to be priced into the oil right now, and I guess the way to look at that as we start to look at what the real value of the market is worth, priced in real assets, whether your basket is gold, oil, or whatever you want to use.
One other thing about oil here, Gordon, regardless of the direction that's going to happen here, one thing that we can be sure is that I'm pretty sure we're going to increase in volatility in the same way that we see the market decrease, get smaller and smaller from the left to the right. We're going to now come back out and we're going to get bigger and bigger. And so we're going to have increasing bigger moves and higher volatility.
Lots to think about. And the way to watch this, I guess, Andrew, is your daily service, where these are all integrated with the drivers, the triggers, the macro triggers, the technical triggers on a daily basis as the news events unfold.
Yes, we take your macro information and we overlay it onto the charts for the timing, and then we cross those over with what the technicals and the triggers are, and those all seem to be lining up and hopefully lead us to where the high probability targets are. And it all seems to be flowing nicely so far.
Andrew, how could our listeners learn more about triggers and your free trial service?
Yeah, the site is triggers.ca, and we do have a free 2-week trial, and that gives us all the updates that I provide, and that's at Tuesday to Friday mornings across 7 different markets, and on from the weekly to the daily to the hourly time frames, and those include your macro input on the time zones and the triggers and the high probability target zones they've been seeing today.
This fall might be the time to be using the free trial to have a look at some of this, just to, if nothing else, for education, to see how other traders look at the market and then decide how they want to make their moves. Andrew, again, thanks for the time. Always appreciate it. Always enjoy it. Month goes by so quickly.
Thanks for having me.
And we'll talk to you again next month.
All right. Take care.
Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.